this is Steve Dale, and I'm the trustee of the Golden State Pool Trust. And for this segment, we're going to talk about tying a supplemental needs trust or a special needs trust to a CalABLE account. So, one of the questions we all had when ABLE accounts first went into effect is, can a special needs trust make contributions to an ABLE account, including a CalABLE account for SSI or Medi-Cal recipients? The question was answered in 2018 by the Social Security Administration and their administrative regulations called the Programs Operation Manual System, or the POMS. Additionally, Medicaid, which we call Medi-Cal in California here, cannot make rules more stringent than SSI, so oftentimes, even for folks that are merely on Medi-Cal, we follow the rules that are in the POMS. To find the regs, which covers many aspects of ABLE for SSI recipients, Google SI space 01130.740, and this should pop up in your browser. So, what the POMS says is that contributions to an ABLE account can come from many different places, including a trust. So what this tells us is that you can make contributions from many different entities, including a special needs trust, but even so, the amount of the contribution is limited to the annual gift tax exclusion, which in 2021 is $15,000. Now, with limited exceptions, the Social Security Administration is not allowed to review the distributions from an ABLE account, and that can have many advantages here. So, the POMS goes on to say, do not count distributions from an ABLE account as income of the designated beneficiary, regardless of whether the distributions are for a qualified disability expense not related to housing, or one that is related to housing, or for non-qualified expenses. Now, we're going to get to the housing thing a little bit later here, but what this is basically telling us is that Social Security eligibility workers for SSI recipients, with very limited exceptions, are not allowed to review what the expenditures are made for. This actually comes under the IRS. So let's go through a little comparison real quick. For a special needs trust, and let's remember that a special needs trust or a supplemental needs trust is a form of a spendthrift trust where the trustee has sole and absolute discretion and the beneficiary has virtually none. For a special needs trust, all distributions must be in the sole and absolute discretion of the trustee, and all distributions are subject to review by the Social Security Administration, by SSI recipients, and by the Department of Healthcare Services for Medi-Cal recipients. Comparing that with the CalABLE account, distributions are in the discretion of the person with signature authority, and with limited exceptions, the Social Security Administration and the Department of Healthcare Services cannot review distributions from a CalABLE account. Even so, CalABLE accounts may be subject to review by the IRS. So let's look at an example. Al is an SSI recipient and the beneficiary of a third-party special needs trust with Ted as his trustee. Ted uses the special needs trust to pay for many of Al's needs, but Al would like to have some discretionary funds to use as he pleases. Both Al and Ted find the requirement that the trustee must oversee every distribution very intrusive. And on top of that, Ted would like to limit the number of distributions that he must be responsible for if the trust were audited by the Social Security Administration or the Department of Healthcare Services. Al establishes a CalABLE account for himself and maintains signature authority over the account. Ted transfers funds to the CalABLE account for Al to use as he pleases. Al uses the CalABLE debit card to make the purchases that he needs, and if the special needs trust is audited by the Social Security Administration, Ted will need to provide for all the expenditures that he has made. The Social Security Administration will not be allowed to review the expenditures on Al's CalABLE account though he will need to keep good records in the event that the IRS audits the CalABLE account. In the unlikely event that Al were audited by the IRS and the auditor determined that Al had made expenditures that are not a qualified disability expense, Al could face a tax penalty.